one of the biggest laws passed in my adult lifetime, One Big Beautiful Bill, which I believe is one of only 3 tax cuts passed in my lifetime, just passed. Now, I'm discovering every day almost a new misunderstanding, a new detail, and as a estate planning, you might look at it as a tax trap. I'm really excited to have today Vishal Petigara, who is a estate planning attorney specializing in high net worth and ultra high net worth individuals, as well as cross-border estate planning. And he kind of gave me some really good insights into the One Big Beautiful Bill tax traps. I wanted to share that with us. So Vishal, what are 1 or 2 of the most common or missed tax traps you think from this bill that it's created for people?
Well, there's a couple that I've highlighted, and thanks, Bill, for having me on today. I guess where we should start is, what is the One Big Beautiful Bill, right? In a historical context, where we are right now is looking at the possibility, where we were looking at the possibility of Trump's Tax Cuts and Jobs Act expiring, right? And as a byproduct of it expiring, the rates would have gone up back to where they were prior to 2016. The estate limitations or the estate exclusion would have drastically come down. And there was a number of other issues that had to be addressed on an imminent basis. Is this a perfect piece of legislation? No, that's okay, but something had to be done. So the One Big Beautiful Bill is basically a tax reform legislation that wanted to cement the Tax Cuts and Jobs Act rates and also make certain features permanent, right? It was a little bit of a grab bag of special interests at the end of the day, but it's part of the sausage making, so to speak, right?
So just to summarize, some of these changes were in the law but set to expire. So this bill made those changes permanent, didn't change anything other than it prevented a change going forward on some issues.
Now that's the thing. Let's talk about permanent, right? Because the One Big Beautiful Bill was passed under what the Senate calls reconciliation, right? So for budgetary bills, fiscal bills, and that kind of thing, there's a faster process called reconciliation where only 51 votes are required in order to pass it. Here's the trade-off. That bill is only good for 10 years. So much like the Tax Cuts and Jobs Act, the One Big Beautiful Bill has a 10-year lifespan, right? So in another 10 years, we're going to have to revisit some of these changes that were made, right? So obviously there's political inconsistency. We're good for 10 years, but what happens from there, right? Let's talk about some of the major features, right? The rates, the tax rates that were in the TCJA were extended, right? So our individual rates are now 10, 12, 22, 24, 32, 35, and it peaks out at 37, right? The old bill peaked out at 39.6. The income thresholds are also now indexed for inflation, which means that over the course of 10 years, as inflation is kind of a problem right now, the rates are going to be indexed for inflation in order to accommodate that issue.
So just to stop for a second, because there's a lot here to unpack, and I appreciate your detail. Some of my answers are, we're not as sophisticated, so I appreciate bringing in an expert like you. The top tax rates went from 36 to 39.5. They had been cut in the prior tax bill, and what this bill did was extend that 36% for the next 10 years. It didn't lower the taxes, it extended the cuts from the prior bill for another 10 years.
For another 10 years, correct.
Okay,
correct.
And then second, the indexing is important because you have a standard deduction, but over time that standard deduction seems smaller as inflation comes up, but going forward, these deductions are now indexed for inflation, so they're going to go up along, if inflation rises, along with inflation to keep up and keep more current. Is that a good summary?
Yes, yes. So that kind of takes us to an interesting question on the standard and itemized deductions, right? Some of them were made permanent. However, there are some significant changes, right? One of them I wanted to talk about is the state and local tax deduction, okay? Ostensibly, the maximum cap for the deduction was increased from $10,000 to $40,000.
So again, just to identify, this is referred to oftentimes as SALT, state and local taxes. And so you write off against your federal tax return the taxes you pay, particularly in high tax states like New York, where you are, and California, where I am, and local taxes. City of New York has an income tax, City of LA has an income tax. So you get to write off those taxes against your federal tax bill as an expense, but there's a limit to that, and that limit got raised by the most recent bill. Not as high as someone did, not as low as someone did, but did get raised, correct?
Yes. It's slated to increase annually by 1% until 2029. And now here's the rub. After 2029, that cap drops down again to 10,000. So it's not a permanent increase in SALT deductions. It's only a 4-year increase in the SALT deduction cap, right? There's also an expanded deduction for modified adjusted gross income for greater than $500,000, which means between 0 and 500,000, 40%, or I'm sorry, 40 up to $40,000 is deductible. After $500,000, a lot of these deductions kind of drop back down. So folks who are very high earners at $500,000 or more,
right,
they're actually going to be they're going to lose the ability to optimize the deductions simply by not being able to take them, or worse, taking a lot less. There's an example floating around. There's an example floating around. LinkedIn, I believe Bob Keebler put it together. Somebody who makes 500,000 versus somebody who makes 600,000, and the adjusted difference between the SALT deductions associated between them resulted in $100,000 plus increase in their tax bill.
Wow.
On the basis, right? So it's going from 40,000 to 10,000 might seem minimally disappointing, but the tax bill that results from that loss of deductibility was fairly substantial, because I believe that you not only have an increased marginal rate at that point, but you also have a lower deductibility threshold as well.
And for those who are watching this, so sometimes when you say make a certain amount of money, we think about our salary, or we think about what we normally get out of our business, or maybe salary from our business. But really, this also applies. I deal in probate and trust issues to kind of one-time income boosts as well. I'm in real estate, and so, for example, I'm selling a property this year. On top of a good year income-wise, we're going to have a large additional income that raises my tax rate this year relative to other years. So which year these laws go into effect are really impacting me, or can I defer it into next year? And so it's not only affecting people who earn every year $500,000, it particularly hurts people who maybe generally make $300,000 or $400,000 and have a great year in a bonus. Well, how do you take that bonus? And if you go over $500,000 and you live in a high tax state like California, New York, you might want to think about that and get with a estate planner to make sure that you maximize, because you might end up paying more net for that bonus than you do otherwise. That's what Vishal is laying out for us.
Well, think about an attorney who works at a fairly large law firm, right? This attorney might be making a base compensation of $400,000 or $500,000, and then they have a bonus coming in, right? The issue is that depending on the size of that bonus, right, that could put them over the edge here, and ultimately their receipt of the bonus is like almost literally wiped out by the tax bill that results from it.
And if the bonus is non-cash, the bonus is stock or something else,
that's phantom income, right?
Well, yeah, meaning you get the income in the stock, but now if you have to pay an extra $100,000 of cash taxes on it, you sell the stock to get the cash. You kind of went backwards in some cases. So again, this is why this is so important. Is it's not just people who every year make a certain amount. I'll never forget one year I was in the mortgage business when we first started. In the first 4 years, we lived very modestly, and my wife and I, we borrowed a lot of money, and we were making money, but it was all in the business, and we didn't cash it out. And about the fourth or fifth year, we took a very large profit bonus that really reflected the prior 4 years, because now we had cash coming in, the business was doing well. And that was the year that the Clinton administration passed the retroactive tax increase for incomes over $250,000, because that was rich, and I had been making about $200,000 a year, but I had put a lot into that 1 year, so I took this bonus out and paid the penalty and the higher rate on the bonus. I ended up losing about 2/3 of my bonus that I worked for, or the profit I worked for 4 years. So again, and I didn't have a good estate plan. I didn't think to go to a professional. And that's why it's not just people who make this year after year. It's also very important for people who have one-time gifts, one-time, of course, inheritance is treated a little differently, perhaps, but or one-time bonuses, one-time profit pullouts. So that's what we're talking about here today.
Right. So, I guess the moral of the story is, given the state of taxation today, if you had a liquidity event coming up and that liquidity event is something that may be taxable, I think that planning around that liquidity event in order to structure it appropriately and better manage the taxation associated with it is probably the best bet.
Yes, 100%.
A couple of other things that popped up here is this one's a good one. The mortgage interest deduction was increased from $500,000 per couple up to $750,000, right? You can also now take the deduction of the interest associated with your home equity loan, right?
Just to clarify, the income on which one can take a mortgage deduction went up, or the actual amount of the mortgage interest?
The limit of the deduction, right? You can take up to $750,000 of mortgage interest and reduce you. Yeah,
that's a good size mortgage.
Good size mortgage, indeed. The other one here is there's theoretically easier access to deducting medical expenses, but I think much of that was kind of eliminated with the removal of miscellaneous itemized deductions, right? Not all of them are gone, but there are certainly enough of miscellaneous itemized deductions that have been stripped away that for a lot of households might be relevant. For instance, the deductibility of legal expenses, medical bills, and that kind of thing are now restricted, right? And I think obviously the biggest news that we have from the one big beautiful bill is the increase in the estate tax from $15 million to $15 million at the individual level, $30 million for a married couple, and that is also indexed for inflation. But there's a big gaping hole. And when people do planning, oftentimes the biggest thing I hear is that there's an acute need for or want of something that is relatively permanent, right? I'm spending a lot of money today to plan for the unknown now and in the future, right? I have to come back in 10 years if this changes, right? So that's kind of the downside of passing a tax bill with reconciliation, is that in 10 years, we've got to look at the planning and make sure it still works.
Right.
So
and make sure you give yourself enough time to make change if necessary, right? You can't plan on December 10 years from now. You really need to plan on June or July, so if there's some changes to be made, you have some time to execute those changes.
Yeah, I would say that you need about 2 or 3 months of execution time, maybe 1 to 2 if everyone kind of like just drops everything. Yeah. But some of these projects are time sensitive and they're also time intensive.
Yeah.
So having enough lead time in order to plan for some uncertainty would come. Obviously, in 2034 is probably when this issue would come up again, and it would certainly be an election year issue as well. That's within what happens here. There's going to be a lot of talk about it in the legal sphere and everything else. So it'll certainly be a subject matter that has to be addressed.
So, okay, so we talked about the SALT, we talked about the standard deduction. Talk about, I think there's a little bit of a misnomer, no tax on tips, but that's capped at a certain dollar amount. No tax on overtime, again, that's capped at a certain amount. No tax on Social Security.
Yeah, it's not only capped, but it's also limited to like the first year, right? So it's a gimme, but it's a gimmick at the end of the day, right? So it's, it sounds good, and I think it speaks to a certain segment of the workforce that appreciates it, but it's not permanent.
Right.
It's not even 10 years long.
Right.
Right. So that limitation is kind of like, when you look at it, there's not much substance there. And, frankly, this bill goes up against the requirement to balance the budget, right? So initially, this bill in its original form would have created $1 trillion+ hole, right? Um, and I think that some of these limitations that are being placed on the things that are desirable to many of the population are just capped and restricted so much in order to ensure that the deficit reduction element of it comes through.
Yeah, I mean, the other part, like Social Security, it's interesting that, unfortunately, my wife had, cancer and was battling it for 2 years, and so we had extra expenses, and she retired. Thank God she's recovered and she's cancer free. But at the time, I thought, well, I'm 65. I could take the Social Security earlier now and kind of help bridge us. It's not a lot of money, but it'd be nice to help bridge things. We have extra expenses, low extra income earlier. And when I applied, and Social Security said, "Oh no, you're rich. You make too much money." It was like, "Whoa, I'm rich!" Like I can only imagine. And I think the same's true now with the tax laws. That it was announced that there's no tax on Social Security. Well, that's true up to a certain income amount. But again, if you make more than a certain income amount, then you're going to be taxed on portions of your Social Security. And so I think, again, a lot of this is, there's a lot of politics here, and I'm not pointing fingers saying who's right or who's wrong or who's good or who's bad. I'm saying is that you have to really dig in the details, and that's why you need a professional who can go through this and apply it to your case, not to the general case, right? Because we're not all voting on the bill. We're now filing our tax returns or making our decisions on our retirement plan.
Well past that. Now it's time to execute in compliance with the law. And the issue here is that there's a lot of interpretation left to be desired. There are regulations that haven't even been promulgated associated with this. So interpretation is going to be fast, it's going to be hard, and ultimately our compliance may be strained because of how we may interpret something versus how the IRS does.
Well, almost always it sounds like I have I do probate and trust real estate, but I end up working with estates, some large ultra net worth, high net worth estates, and I was surprised when the accountant kind of leaned on the tax issues, required an appraisal. I said, well, first off, we're keeping a lot of most of these assets. The ones we're selling, we'll have an appraisal from the buyer, so we'll know what those values were. But in California, we also do a date of death certificate, date of death appraisal on the whole asset. And the accountant said, no, you really need to have a formal, certified appraisal for the IRS. I said, well, I understand. California requires the probate referee, we call them in California, a certified. It's not really an appraisal; it's similar. And I said, why? He said, well, because the IRS is going to challenge it. They challenge every estate over, a certain amount of money. I think he said $10 million. They're just going to challenge it. So you have to prove it. So you might as well just do it now while you're up and running and have those activities in place. And so it's just interesting that, whether he's right or wrong, you have to have a plan. You got to execute the plan. You need a quarterback to call the play. But my point is,
right? States like California, New York, and other various jurisdictions, New Jersey being one of them, I can think of a few others. They each have their own set of state laws. They don't necessarily comport with what the federal rules and regulations are. Right. I know that Pennsylvania has on the books that the laws and regulations of the federal government likewise apply at the local level, but not every state does that. Right. So there is a requirement that we must actually plan and predict, because the state's interpretation of the treatment of certain income amounts and that kind of thing may vary from federal. Right. So where you might have a savings on the federal side, you could actually end up with an increase in taxes on the state side.
Right.
And likewise, the state may have different requirements from the federal government. So you have to have a advisor, CPA, lawyer, etc., who can handle the differentiation.
And then you can even layer in another, which would be local laws. In California, a big part of our life is property tax reassessments, right? And so if we tightened the exclusions to just parent to child. There used to be almost any relative could pass a property and avoid property tax reassessments. And you say, well, what's the big deal? Well, the houses that have been held in families now for generations that were bought for $30,000 in 1950, they're worth $5 million today. And the difference in assessment is 1% is going to be like $50,000 a year Yeah, $50,000 a year difference on the assessment alone. And so, is it worth getting an appraisal? Well, yeah, if you can avoid a reassessment. But you might save money on your taxes and lose on the lose a reassessment option, or you might, avoid reassessment but trigger some sort of a tax consequence. And so, you really need somebody who takes a holistic look at the whole thing, which is where I step out and say to the accountant, "How can I help you? I'll get you the data, but I'm not here to make those decisions."
Right, right. That's interesting. Situations like that, where you have a heavily appreciated asset like a home that was bought for 30,000, now it's worth 5 million. Um, One of the things I would recommend to somebody who is using that home as a legacy asset, they want to pass it down to their children, etc., is that they would want to consider using a grantor trust or something to that effect for holding their property, right? So there's a couple of things, right? You have one of the things that we want to do, especially for elder planning, is something to the effect of like a Medicaid asset protection trust, right? The issue becomes if planning like that occurs, we have to be cognizant of the fact that if the client or patient passes away, right? Are we going to sacrifice the heirs step up in basis, right, for today's planning, or how do we preserve the heirs step up in basis in order to affect a Medicaid asset protection trust for elder costs, right? So, financial planning and tax planning, really operate together because, insurance policies could be purchased, and likewise, some things that we might feel are expensive today are going to save us a heck of a lot of money down the line.
Yeah. Having some liquidity, I think, is so important. I'm the real estate guy, so oftentimes they don't have any liquidity. They have to sell the real estate, and that's where I come in. But the reality is an insurance policy or a portion of the assets held in liquid that you can deal with the taxes and avoid being forced in decisions, I think can save a lot of money to estates. It has to be part of it. And I think the way you just described it, to me, it's like I watch it like it's a whack-a-mole, right? You have the tax issue, then you have the assessment issue, then you have the liquidity issue, then you have the state tax issue, and what's the best outcome for all of that? And I think, again, the right answer always is individual, and it requires, particularly when you talk about a lot of money, requires really planning ahead of time, understanding the whole picture, and making a plan, and then in this case, adjusting it as the laws change. But they change in federally this year, but last year we had a lot of state law changes in California in particular, and so you had to stay on top of these things and evaluate them as those changes come into play.
So, I just want to indicate that our firm, there's a lot of planning firms that kind of like intake large amount of clients and then just kind of run through a document preparation software and pump out standard documents, right? Given the unique circumstances of all of our clients, right, one of the things that we pride ourselves on is that we are bespoke planners, right? We're a boutique firm, but we're also bespoke planners. Every document that we produce, every plan that we create is individually tailored to the needs of the client, right, and the client's family, right? We have meetings with the client, several of them, in order to identify these needs. We have planning meetings to identify the plan we've created. And then, we literally spend 3 or 4 hours running through the documents with the clients to ensure that they understand what their rights and responsibilities are.
Yeah, really critical. And then hopefully make sure that we have a plan and make sure we execute the plan. And I'm currently working on an estate that's got $40 million in assets, and he met with an estate planner, wrote a big check, put a lot of work in, never signed the documents. We have a beautiful binder with some great docs. I'm sure it's one of the world's great estate plans ever created, but the fact it's not signed makes it virtually worthless, I think. I mean, you can talk about the intentions of the will part, but he had a separate will, so technically even the will is of limited or no value from a legal point of view. So it's just so frustrating.
I would arguably say that, an unexecuted set of documents is the worst thing that could happen, right? Particularly with an estate that has some assets in it, because that's going to create conflict down the line. And that's usually the one thing that a decedent client wants to avoid.
it just all can be used for is conflict, right? All it can be is, oh, he said he was gonna, leave me this, but it didn't get effectuated. Why did it not? Maybe it's second thoughts. Maybe he changed his mind. Maybe that second thought was why he. We don't know. People are complex. Why they never signed something? We could say they're busy. We could say they're lazy. But there's also the human element, which is, do you really want to disinherit your children or your ex-wife or whatever the story is? And like you say, to me, the unexecuted plan is just cannon fodder in a probate case objection. I just see it all the time.
Correct.
Okay, so obviously you have you use the word bespoke. I think being a Californian, we would say custom approach to your business, which really requires a one-on-one. Obviously, people would reach out to you individually. I put up on the screen your phone number and email. What's the process look like? Give me an idea for somebody who's looking to get into.
Let me kind of tell you about something here. I noticed that you're saying New York estate planning attorney. We're based in New York, but we work with clients who are literally everywhere, right? I've got clients in California. I've got clients in Texas, New York, Pennsylvania, New Jersey. I got one client in Wyoming, actually. But even more important, I have clients who are overseas, who are planning for U.S. beneficiaries, right? So obviously I work with folks who are typically $5 million plus, but I have no problem working for people who are up and coming, right? A young physician family, a young, professional family, who is clearly going to be set for the future, right? But the process is I'll have an initial meeting with a client. We'll talk about their goals. We'll talk about their wants, their needs. We'll talk about their assets and any idiosyncrasies associated with those assets, right? We go back, we develop a plan. We review documents, we review financial statements, we review prior tax records, and then we'll create a roadmap, literally a roadmap, a PowerPoint deck that identifies and articulates and turns it into a visual, the asset layout that they have today, the asset layout that they want to have, and we'll put together a literal plan on how to do it and articulate and identify every document from an assignment of interest, an assignment of property, all the way to the trust documents and wills, right? We'll articulate all of that. We'll discuss the plan with the client. I want the client to understand what it is we're doing. And then when they say, okay, that sounds great, let's do it, then we will execute, we'll draft all the documents, we'll have a review of the initial drafts, we'll make the edits as necessary, and then we'll have a quote-unquote closing. We'll meet with you and we'll sign. Very typically, if my client is not in New York, I will have local counsel at my expense come do the execution. If they want me there, I'll certainly be there, but local counsel will handle the signatures. And then we'll prepare any filings as necessary. We'll put together the binders, and you get a binder as well as an electronic copy of all your documents. And then we'll follow up with you at least on a yearly basis to make sure everything's working. And if you need anything else, we're there too.
Well, I know it's very personalized, and I was referred to you by one of my best clients, who's a licensed fiduciary here in California, who introduced me to you, and also does work outside of California. I think it's very common. New York businesses, I think, have to be able to be more national and, in many cases, international. It's not as common in other markets, probably Los Angeles some, but so I appreciate you correcting that. So again, Vishal Petigara, and then to contact, phone number on the screen, 215-527-4366, and his email as well, vishal.petigara@petigaralawgroup.com. Of course, if somehow you need this and you miss it, feel free to reach out to me, email, text, or phone call. I'll be glad to pass on the info. He also is on LinkedIn and has a profile there, very handsome picture, and more importantly, yeah, well, and he's taking care of his customers sometimes, but I think it's enough. Again, you can find him on LinkedIn, or again, the phone number, email we have here. If I can help put you guys together, also feel free to reach out to me. I'd be more glad to make that connection. Vishal, thank you so much for explaining to us some of the tax traps of the One Big Beautiful Bill, as well as the importance of doing planning overall. Really appreciate your time today.
All right, I appreciate you having me on. Thank you very much, Bill. I'll speak to you soon.
Thank you. Thank you so much. And for the rest of you, this is Probate Weekly. We get together every week and talk about issues both probate and avoiding probate, which is estate planning. Oftentimes, though, we try to estate plan and avoid probate and end up in probate court litigating these issues. So I do interview attorneys to cover these issues all the time. You can continue the conversation on our Facebook group. Probate Weekly is on Facebook. If you need a referral for a real estate agent or an attorney, other states, you have questions in other states, feel free to put them there. We have a pretty active and engaged group. We issue a new episode every week. You can sign up at probateweekly.com if you want to get email reminders as well. Love to have you do that. On this or any other, feel free to write comments, questions. If you are an attorney want to be interviewed or a vendor want to be interviewed, please send me information. If you know somebody who should as well, please feel free to make the introduction. As always, make today your best day ever. Thank you so much.